Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hi, this is James Kandasamy. Thank you for listening to this podcast. I appreciate you. I know I provide a lot of value through this podcast, and I want you to share it with your friends, with your families, and anybody else that you know that kind of benefit from listening to this kind of content. Go and share it through Facebook, through LinkedIn, through Twitter, through Instagram, or any other channels that you want to share it, because sharing is caring. Thank you. Let's go on with the show.
All right, let's talk about bank failures. So they're back. We had 4 of them last year. So go to the FDIC site every Friday at about 5 o'clock and see if they took over anybody. And if you want to know who they're going to take over next, here's a good way to do it. It's the Texas ratio. So the Texas ratio was developed at RBC Capital Markets. It's maintained by deposit accounts. Put the link there at the bottom. They do this for every bank in the country and every credit union. And what the ratio represents is the percentage of a bank's capital that is restricted by bad loans. So it needs to be a pretty low number. 5% or less is considered healthy. When you get to 10, 15, or 20%, you need to be raising capital. When you get above 20%, you're probably start worrying about a visit from the FDIC on a Friday afternoon to take you over. So what I wanted to show you here, I took Texas and I took the riskiest banks. And Dallas is a healthy economy. Look at the number of banks in the Dallas region that are above 5%, above 10%, above 15%. This is not what you'd expect. So why is it that maybe some of these banks in Dallas and Texas, and if you look at Louisiana, a similar situation, why do they have such higher Texas ratios? It's not just due to COVID. It's due to energy. Look what we've been through with energy in COVID in the past year, and what we're going to be going through going forward here with everybody give up carbon and electricity. You guys had a taste for what it's like to not have electricity. We don't have enough windmills or solar panels to make everything work. The other is the Gulf region and the 30 storms. So a combination of hurricanes, energy, and COVID has hit Gulf states banking harder than other regions of the country. So there's kind of a reason for it, but I would check in on this if you've got a client or a property with a certain loan, or you're doing a renovation and you're worried, or a loan coming due and you want to see if the bank's going to be able to process it. I keep an eye on how healthy your bank is. You want to see and be doing business with banks and credit unions that have a healthy Texas ratio, and those that don't, you might want to hedge your bet by having a little more diversity in your banking relationship. So this is my early warning indicator, like TSA passenger count or Becker vaccinations. The other one.
So what happens if a bank fails?
So it's pretty seamless. The FDIC has this down pat. They already have suitors lined up. I was at the Fed. We identify potential suitors to take over the assets and the loans, honestly, 1 to 2 weeks in advance. It moves very quickly. The depository accounts are insured up to a certain amount. Be careful if you're a business, because all of those, what we learned during the Great Recession was businesses that accumulated their payroll in an FDIC assured account that was only insured up to $250,000, but they had $1 million or $2 million in payroll, they only were insured for $250,000. So there was some intervention that was done to kind of help mitigate that. Those all went away. So if you're a business and you're accumulating your payroll, especially on a Friday or at the end of the month, I'd be careful. But it's a pretty seamless process. The FDIC has a down pat. They have another entity that takes over. Your loan is still serviced. You still have to make your payments. There's no holiday on loan payments, and the branch actually opens up immediately the next day. The ATM is all recoded, so your card still works, and it's a pretty seamless process, unlike the 1920s or 30s.
Well, unless you have more than $250,000 in savings in that particular bank, I guess. So that's a big problem.
So I'd refresh yourself on all those rules, and particularly if you're a small business or a brokerage or a property manager and you're accumulating rent collections or payroll, and that gets above those insured amounts, it's all at risk. So that's why you might want to deal with a larger bank or a different structure where they can provide a facility that protects those deposits above the FDIC limit. So the other one here is on banks and their earnings. So as we knew, last year the regulators made the banks quit paying dividends and quit buying their stock back and reserve more capital for the flood of bad loans that were coming. They did stress tests at the end of the year. They saw no bad loans. So what did they tell the banks to do? Go start releasing your loan loss reserves. That was a pretty dumb move because we haven't even seen the wave of those loans come yet because of all the intervention. And I worry that the banks right now, their stock price is up because the earnings that they're getting and beating is largely due to them releasing loan loss reserves. And I think they're going to need some of those for C&I loans, small business loans, closed restaurants that they discover later in the year, hotel loans. I think all that's ahead of us at the end of this year, and that the banks may have released too much of those earnings, those reserves for earnings, and they're going to have to go back into build up the reserve mode again later in the year. So be careful. I put on the right, this is a kind of a schedule. You can go to Business Insider at the beginning of each quarter's earnings season, and they'll stratify by industry and sector who has the big flow of earnings releases. The banks always go first, about 3 to 4 weeks into the new quarter, and retail's usually at the end. So the darker green is the higher percentage in that sector that come due. I'd have this on your radar for a couple of reasons. Look at the companies, the public companies that influence your local economy. Look at the public companies that occupy your real estate, whether it's a downtown office building or whether it's a manufacturing facility, and look at where that workforce is. So a big public company that has a lot of workforce in your market, you might want to pay attention to their earnings because that could foretell, good news and bad news. Home Depot just announced they're going to add 3,000 more jobs to the Atlanta market. That came out in their earnings report. That was really good news and very bullish for both the single-family, multifamily market in Atlanta. But it could go the other way with what's happening with some retailers and other companies. So pay attention to the earnings, understand what's going on. It has a huge impact of what's going on in commercial real estate. And here's the good news. If you want a crystal ball on how commercial real estate is going to do 6 months out, pay attention to the earnings of public companies. They tell you everything that's going to happen 6 months down the road. They're already doing it by their behavior, whether they give you forward guidance or not. All right, I want to digress for a minute on valuations because we sometimes just look at market conditions and occupancy rates and rents and cap rates, and we forget how those influence valuations and what the real estate's worth and how we get capital for it. So I brief the bank regulators every quarter. I've been doing it for 13 years. I'm the only MAI that they have do it in the whole regulatory system and from the industry. And it's because I tell them the truth and I go off script and I tell really good jokes. And I always, James, wear my really fashionable red shoes. So this is what really does it. So this is a graphic I put together years ago when I was at the Fed, 2005 to 10, that wanted to remind the regulators and the Fed presidents and even Bernanke how these problems happen. And these cycles work the same way. We start with easy money, like subprime mortgages last time around. What's the easy money today? The Fed. It's free, no interest rates, 2.5% mortgages. Then we get a misreading of demand drivers. What are public builders doing right now? They are loading up on land again. And that land isn't going to have houses on them probably for 2 years. And what do you think the environment's going to look like 2 years from now? You think we'll still have 16% a year home price appreciation? You think that we might risk for a normal recession after all of the boom after COVID? I think that we're going to repeat just like what we did in the housing crisis where all the public builders got stuck with a lot of excess land. So we misread demand drivers. We think we need lots of land and lots. Then we erode underwriting. We think it's worth everything. We think we're going to sell 50 homes a month. Then the market changes and we have loan losses and it all starts over again. And these cycles happen. We go through them in a real bad way every 10 years and they rotate between residential and commercial. Last time it was residential. I think this next one is going to be very severe on the commercial side and maybe not as much on the residential, depending on how we undo the forbearance things. So I wrote a piece mid last year on valuing commercial real estate during a period of material change. So material change is a technical term in the bank regulatory world. It's kind of your expiration date on the milk carton. It tells you when you have to get a new appraisal, when you have to refresh the value. And something like COVID is a material change. And technically the bank should be reappraising every asset, but they're not. So why aren't they doing it? One, we have intervention. That's kind of skewing it up, and the regulators are telling the banks, don't worry about it, we want everything liquid. And the second thing is, where are the comps? So you look at office buildings, you look at hotels, there's not a lot of sales. So getting a new appraisal without sales isn't very meaningful. So I want you to be aware of that's a very important technical term, and the regulators, if they don't take their meds, they might wake up one morning and say, Barney 5, material change, you're under arrest, go reappraise everything. And you could have borrowers and everybody that are really jammed up. So what drives and guides all this is something called the Interagency Appraisal Guidelines. The last time it was updated was when I was at the Fed. It's one of the co-authors, and it was right before I left in 2010. And it's the rules of the road. And it's rooted in FIREA. It embraces USPAP. And so it's very important, but it's very out of date. Doesn't address even Dodd-Frank. Dodd-Frank hadn't even been implemented when this was last passed. So what the regulators are trying to do is they're trying to supplement it right now with what they call FIL letters, financial institution letters. So why don't the regulators want to update any guidelines or guidance or rules or regulations? Because the public comment period in the politics in this country is ridiculous. You probably take 5 years to get it through public comment. So these FIL letters are meant to be a Band-Aid, and they're horrible. They tell you nothing, but you better be aware of what they're commenting on, because at least the comment, if they're talking about a comment on LIBOR transition or something like that, or material change, it's on their radar screen. You better start understanding what that term is, but they're not telling the banks much about what to do. So I'll tell you who is that's really on top of it. And this even surprised me because we don't tend to think of the credit unions as being the leading entity on regulation and good supervisory policy. But the NCUA has come out with new 2021 supervisory guidance that is spot on. I tip my hat to it. They're addressing LIBOR transition. They're addressing your loan loss reserves, what we call ALLL, the allowance for lease and loan losses. They're dealing with hemp. How do you classify a loan or regulate a loan in Florida that has a hemp business in the real estate? It's now legal. You can't criticize it. So really tip my hat to the NCUA. So this is one that I pay attention. They've got a lot of good guidance that the FDIC and the Fed should be helping their banks out with. So the reason I set that up is I'm doing now on a quarterly basis. I brief the regulators. I share with them what concerns me, what I'm seeing, and what they should be thinking about. And I take a lot of questions from them. They're letting me now on a quarterly basis share some of that that's not confidential or supervisory in process or super handshake related for FOMC meetings, and share that with you. No one's ever done this before. I'm the only person that does this in the country. So we've developed a webinar series that we're going to launch. The first one is on March 23rd. I've already done my first quarter briefing to the bank regulators. And here's some of the stuff that we're going to share with you. I'm going to do this again in June, the third or fourth Tuesday in June, and the third or fourth one in September. And I'll share again what's evolving with the regulators and what they're telling you about construction loans and commercial real estate loans and appraisals and all that kind of stuff. And so here's the link if you're interested. I tried to make it a real deal. It's $1,500 for all 3 sessions for as many people in your organization as you have. So it's a deal. No one else has done this, has never been out there. So if you're interested, if you've got a lot of debt, if you got maturing loans, if you're a banker, I really encourage you. I think this will be worth your while. And if you don't like it, let me know. I'll rebate you, or we won't make you pay until after the first one on March 23rd. So I just wanted to share that with you to help you.
Yeah.
I want to put a plug in. I know you're more residential, housing, multifamily concentric. I want to put a plug in for CCIM Institute. Logistics is huge. And so we just developed the first ever industry course on last mile logistics. What is it? How does it work? How do you find one? How do you make money at it? So it was free to all CCIMs that renewed their 2021 dues. I've developed it with the Institute. So be able to be proud of the Institute. Here's an area that they're leading in, and tip our hats to CCIM. And along that lines, I want to call your attention to something that released last week. And I recorded a podcast with CCM Communications team, I think last Friday, that will release maybe this week or next week on the American Society of Civil Engineers every 4-year report card on our infrastructure. And they rate 17 categories, everything from aviation to wastewater. And every 4 years, they give it a grade. It's a phenomenal report. It's 172 pages. So if you're having trouble staying awake and need something to read that'll put you to sleep, this will do it. But except for me as an economist, it keeps me up all night. So here's the good news. For the first time in 20 years, our grade went up and came out of a D. It was a C minus. But it was only that because of 2 categories, ports and rail. They were the only 2 to get a B grade. Everything else was a D with a couple of C exceptions. We really aren't making a lot of progress on infrastructure, but it's important to understand this and why. You asked a question, James, earlier, why Texas? Why are you doing so well? Remember I mentioned it's the whole complete package of infrastructure, whether it's electricity or ports or rail, business or schools, bridges, your airports, you have the full complete package. And companies don't want to build or put new capital assets to work or develop them in places with bad infrastructure because they can't work. And so that's part of the answer. This is very good and accretive for Texas and many parts of the country, the Southeast, Florida, Mid-Atlantic, the Carolinas, Tennessee, the Intermountain region, Utah, Denver, except unless you're going over the ski industry, the highways are terrible on I-70. Just go to Utah and you can be up at the ski slopes in 20 minutes from downtown Salt Lake. So this is a very important item I'd encourage you to look at. And you can look for this podcast. I give you all the cliff notes. And with that, I'm done. We can take some questions. Here's a little more about my team. There's 3 of us. We're a majority women-owned business. So I try to walk the walk with ESG, environmental social governance. I'm the only aging white male in my whole company. So we're trying to exterminate me and make me extinct. We have all female minority interns and students and assistants that are helping us. But we do a lot in economics and forecasting and consulting and expert witness testimony, helping people with appraisals, appraisal reviews, helping banks. The whole basket. I have no handcuffs on me that I can do and say anything I want. It's my own company. I have great partners, Beverly Keith in North Carolina is a CCIM, past president of the North Carolina chapter. So I really have a good team. I'm really excited at 58, being an entrepreneur in the middle of a pandemic. It's working out. There's where you can find us. There's our menu. And with that, I'm done and I can stop sharing and we can see if you want to take or talk about it.
Casey, can we go to the few slides which shows the cycle of the loan and how the liquidity changes? Can we share that? I have a few questions on that. And are you saying rent forbearance in multifamily is not considered delinquent based on the tracking by TRAP?
Yeah, they can't. The agreements are such that if you're in a forbearance outside of the normal loan agreement or the parties, so it's mandated by FHFA or the GSEs who hold the loan, Freddie or Fannie, it can't be classified as delinquent or forced transferred to the special service. So those numbers are really skewed down right now.
Okay, so 3% may not be 3%, could be much higher.
Nope, I think it's more like 5 right now and going higher if we really counted it.
Okay. So what happens with all the money pumping that's being done by the Fed? How would that impact inflation, and how would that impact the potential rent in multifamily?
Great question. So I took my Fed slide out because it's so depressing. So here's the first thing. So the Fed has ballooned its balance sheet by almost $4 trillion last year, from 3.2 to 7.5. That's the largest it's ever been. It got up into the 4 trillion range with the Great Recession. And the biggest increase in that was mortgage-backed securities. They bought over $2 trillion in the last half of last year. So the Fed is supporting housing. That's why we haven't had a housing crisis. If you're in mortgage delinquency or you're a mortgage forbearance and the FHA wants to sell that mortgage, the Fed will buy it. It can get liquefied so the GSEs can keep going. So they're buoying the housing market because they know with a pandemic, if you have people become more homeless and you have the foreclosure and eviction process like we had after 2009, probably we would implode from a pandemic standpoint. So does the Fed back off on that, or does the Fed continue it? And here's the test. So we've seen the 10-year Treasury rise to 1.6. I think it was in the 1.5 range today. On November 10th, it was 71 basis points. And on November 11th, it went to almost 1%. That's an incredible jump in one day. So what happened? On November 10th, the Treasury took the largest auction of 10-year Treasury bonds to the market, and the rest of the world said, no, thank you. So there were not enough counter bids. The Fed had to intervene. The price had to rise to try to bring people in to buy. And what the rest of the world is discovering is the Fed, in concert with Treasury, is devaluing the dollar. We're devaluing our currency. And Congress is exacerbating it with these stimulus programs. The $1.9 trillion that we just passed, and the checks will start going out this weekend, we still have $1 trillion we never put into the system that's already been approved. And if you see the economy recovering, we're putting way too much into the system, in my opinion, and we're setting ourselves up for even more inflation. And the other thing that I worry about in this whole process of the stimulus is a lot of it isn't targeted. There's a lot of waste. I'll give you a couple examples. There's $300 million in this bill to study COVID in animals. We don't think animals transmitted. I think there's been one example on lynx or fox furs, or forget what they are, out of like Switzerland or Norwegian. They found some there, and the mink, all the mink animals, but we're not seeing it in cattle and chickens and our pets. 300 million. Nancy Pelosi has a multi-billion-dollar program that's going to build a special light rail train in Silicon Valley. I think the Silicon Valley folks can pay their own freight train. I mean, there's just a lot of waste in this. And less than 10% is really going directly to state and local government. Less than 10% is going directly to schools to help them get opened. And so there's a lot of talk about we need $1.9 trillion, and probably anywhere between 30 and 50% of that is pork and waste. And we can't afford it. Our kids are going to have to pay this off. And as the rest of the world says, you don't have the growth, you don't have the fiscal discipline, and you're printing money, and you're a fiat currency, which means there's nothing backing it. So what has to happen? Interest rates rise, your currency devalues. And so what's the hedge in that? It's commercial real estate. But the cost of debt, right now we have a very favorable spread between debt and cap rates. And so if you can borrow at 2.5% to 3% and you can get a 6 cap rate, that's a pretty sweet deal. And so that equation is going to narrow. And I think as interest rates rise, and I think the Fed is going to have a real problem on its hand by the second half of this year. If we truly see 6 or 8% GDP and this economy really open up late summer and early fall, the Fed's got a real problem. It's either going to have to step in, buy more treasuries, buy more mortgage-backed securities to keep the interest rates down, or they're going to have to let it go. And we're going to see a 10-year Treasury at 3% or higher. My forecast the first week of January was that we would see a 2% 10-year Treasury by the fall. We're almost there, the way we're going. And it wouldn't surprise me to see us hit 2.5% to 3% by early next year. So as you're doing your debt financing, think about two things. The cost of that debt capital is going to be going up, I think, in the latter half of the year and next year. And what's the other thing that's going up? Construction and material costs, lots of inflation. So if you have inflation, I'm doing a home renovation right now. Stuff that we used to be able to get in 1 to 3 weeks is now 3 months. The costs are up 20 to 25% from when we bid the job just in December. So not even 3 months. So a lot of these things are going to get out of balance. And I think what it means is existing commercial real estate, existing apartments, existing value add in the suburbs are going to go up in value because the replacement cost is much higher. So commercial real estate's that perfect hedge against inflation. We already have inflation. I think it's at the 4 to 5% range. Look at lumber, look at steel, look at copper, look at everything that you consume in your daily life. Look at meat at the grocery store, look at fruit and vegetables. Except for clothing, I don't know anything that isn't up 5, 10, 15%. So remember the Fed and the CPI and all this stuff, it's a cooked algorithm and they change the weighting. So one example is housing. And in the CPI index, if housing costs are falling, they increase the percentage that housing represents in the CPI. If housing prices are going up and rents are going up, they decrease it. So they mask the thing. My favorite exercise I did at the Fed was the Fed economists were telling me in 2009, 10, 11, 12 that there was no inflation, particularly in food. And I said, really? How do you justify that? So they went and they bought a basket of goods at the grocery store and they said, okay, this is the basket of goods that we bought. We buy the same basket every month. Here's the box of cereal. Here's all these different packaged food goods. And they said, see, the price is about the same, $1.99 a box, $3 a box. And I said, that's interesting. How many ounces are in that box? The number of ounces, the box was the same size, the price was the same, but there was 25% less ounces. So my response to him was, for that box of cereal, as long as you're comfortable with your kid only being able to eat until Thursday breakfast cereal because there's not enough there for Friday, then you're right, there's no food inflation. That's the kind of academic stuff that goes on in the Fed and these institutional academic economists that don't understand what we're dealing with in the real world. So I think inflation's already here. Debt costs are going up. Commercial real estate's a beneficiary and a perfect hedge. Do what you can right now with the rates the way they are right now. I'd be leveraging up like I can. I don't know if we'll ever see rates like this low again. At least not while I'm still alive. I'm 58. So I think I'm out of here before they go down again.
Yeah. And what about the potential minimum wage increase to $10 or $15? How would that impact the rents on multifamily?
So it tends to help it because that demographic tends to be more dependent on that type of wage structure. So it helps them. It means they could absorb rent increases, means maybe they could move up into a better apartment unit. So it tends to help multifamily more than single family. It's not going to happen. The complexities of implementing it, what is $15 in New York versus $15 in Macon, Georgia? Two totally different numbers. How do you enforce it? How do you implement all of that? It's not going to happen. There'll be more pressure through tax policy and other incentives put on companies to basically increase their wage rate. And we've already seen that. Walmart's already done it. Other retailers have done it. Grocers have done it. They're making such great margins with e-commerce and being able to do things more efficiently through e-commerce that they can actually afford to pay more workforce, and they actually can eliminate more. So the ones that really get hurt are restaurants and the leisure and travel industry. So I don't think it implements at all. It's too complicated. We'll have our own version of Brexit. I told you, I think last year it would be called Florida and Texas just exit.
Yes. So was there any part in the history that we have come to this kind of potential inflationary period, and what happened during that time?
So you're going to hate my answer. So I actually feel that what we're going through is very reminiscent of the Jimmy Carter presidency. So let's go back to the 1970s. We had Nixon. Nixon had inflation. How did he try to fight it? He put price controls in effect. That didn't work. He lifted them. We had a big political event called Watergate. Gerald Ford came in as president. He did the right thing, I think, for the country, which is pardon Nixon, get him out of there, try to get us to move forward. And so the country can't forgive that. So he gets booted and we bring Jimmy Carter in. Jimmy Carter, great guy, great international person, great military, Marine, nuclear submarine commander. Maybe not his strongest subject was economics. And what happened? All hell broke loose. We had the, inflation. He didn't know how to deal with it. He had a Fed chair, Paul Volcker, that said, let's just shut the economy down. Let's go to 21% prime. We had the misery index. We had an energy debacle. That kind of sound familiar? We're saying, let's not be energy independent. Let's look what's happening to gasoline prices. Look what's happening in Wyoming and the fracking regions. So I think this is very reminiscent to that time. We didn't understand what we had or what was working from a policy standpoint. Forget Trump as a nice person and congenial guy that played well in the sandbox, But on policies, I happen to believe many of his policies were spot on. You got to control your borders. That's a lesson from Brexit in Europe. You've got to, I believe in deregulation. The biggest thing he did to boom the economy wasn't his tax act. It was deregulation. Let businesses work, create more capital, create more churn in the economy. I believe in a lot of his policies. I wouldn't want my daughters bringing a Trump person home as their fiance. But from a policy standpoint, I believe a lot of it worked. I believe we didn't appreciate it. We couldn't separate the personality from the policy. We've done a complete 180. And I think it's just like what we went through in the 70s, going from Nixon and Ford to Jimmy Carter, not understanding what was working in the background, and all hell breaking loose. And now think about Treasury and the Fed. You have a former Fed chair, Janet Yellen, running Treasury with one of her best buddies, Jay Powell, running the Fed. So whatever they want to do in terms of calling up and say print more money and do whatever, there's no checks and balances on the Fed. And it scares the bejesus out of me. And the last time we had a major fiat currency implode in the world was Germany after World War I. In 1990, the trade of the German mark to the dollar was 12 to 1. 3 years later, it was something like 2 trillion to 1, and the economy collapsed. And Germany was doing a lot what we're doing today. So we better pay attention to what's going on in monetary policy, our Fed, the checks and balances. We don't have any checks and balances in our government today. And so it scares me, it concerns me. We aren't students of history. We don't teach it anymore. I wasn't a fan of history when I was a kid, but I've learned to appreciate it a lot more. And so I think I hearken back to really that 1976 to 81 period of time, and I hope we don't go through it again. My dad was a ski resort developer in Colorado. We went from living in a wonderful home in the Denver Country Club and having live-in help and a wonderful life, and 2 years later, I'm sharing a bedroom with one of my siblings and wondering what the hell happened to life. And every construction loan got called due, and it was a horrible next 10 years. And sometimes we don't pay attention to what's coming at us. And I don't think we're paying attention to what's coming at us right now.
Got it. I think someone else said there's something somewhere in the slide which says Bitcoin is more than $50. Can you explain?
It's 56,000 today, an all-time new record. So, and that's another proxy for what's going on. The rise in Bitcoin is a vote against the dollar. So think about Bitcoin. We're not making more Bitcoin. They're not increasing its supply. So you got lots of demand. People want to hedge. They want to use it for different things. And one of the reasons companies like Tesla want to use it, I wrote a paper on this years ago when I bought my Toyota from Toyota. I was working with the Toyota procurement executive, and he was explaining to me how they were then using Bitcoin to acquire the components and commodities that they needed to build cars to hedge against the volatility in currency prices and the currency volatility. And so they would buy Bitcoin. It's an algorithm that mutes out what's going in monetary policy. So if you think the Fed's going to print more money and devalue the dollar, the algorithm says you should buy goats in the Swiss Alps, and they'll go up in value by the amount that the dollar goes down, whatever the algorithm, I'm being absurd there. But that's what it basically is, and it enables companies to still have trade at the same pricing without currency volatility. That's why corporate entities are moving into Bitcoin. It's a stabilizing of prices as we do global import-export trade. And so it's no longer how it came about, which is trying to launder the proceeds from illegal activity, whether it was drugs or not. That is so far removed. But we're not increasing the supply of Bitcoin. We sure as heck are increasing the supply of the dollar. 20% increase in money supply last year. So it's a proxy on what's happening to the dollar and what you can expect. Also, what's your other equivalent to a proxy on Bitcoin? Cap rates for commercial real estate. In industrial, the public REIT that I serve as a director on, we've seen cap rates go from the mid to high sixes into the 4% range for the same asset. You're seeing it in multifamily. Look at the competition, look at the decline in cap rates. Cap rates are a mirror of risk. And people look at real estate, commercial real estate, as a hedge on risk, that it's more safe, that the replacement cost is going to be more than the current asset. And it provides a nice coupon. And remember what most retirees, baby boomers, and pension funds are looking for today. They're looking for yield. They can wait and be patient for price appreciation in the stock or the asset, but they're looking for yield. And commercial real estate provides what Bitcoin can't. It provides a yield. And so our industry and our layperson hedge or alternative to Bitcoin is commercial real estate, whether it's a duplex, quadruplex, apartment, couple of single family homes for rent. And that's why I think we're going to see a very strong commercial real estate market. And if you go back to the 70s and look at the time frame of owning commercial real estate from the early to mid 70s into the early to mid 80s, if you entered the 70s owning commercial real estate and you had staying power, you put the debt in place, you balanced everything, you knew what you were doing, and you could make it through 5 to 7 years, guess what? You about triple or quadrupled what your net worth was. And I think that same thing's going to play out here for commercial real estate. Whatever we're about to go through, I think commercial real estate is going to be a really nice hedge and wealth preservation tool. And that's an important message to have with your clients, your investors, and especially right now where you can still borrow really, really cheap and have that nice margin spread between the cost of debt and the cash on cash yield. It's something that we rarely see. This has only happened maybe 2 or 3 other times in the last 75 years.
So they're saying invest as much as possible into commercial real estate, right? With the rates being so low right now.
Borrow like hell at 2.5%. We just did a bunch of refinancing. I couldn't believe it on our industrial assets. Everything we're rolling over, and we're getting rates at like 2.3 to 2.5%. And we're buying assets at, high 5 to low 6 cap rates. That's a beautiful spread. Things really work well. They won't work so well a year from now when that number compresses.
Yeah. Other questions? Texas cities has been aggressive about property taxes. How does Texas rank with others on this, and how will it affect business migration to Texas?
So we're all going to pay taxes. So in Texas and Florida and Tennessee, you don't have as much in income taxes, but you make up for it in things like property taxes or other user taxes. I think most companies feel like they can better manage that in the workforce and population migration feel they can manage that risk, but what they can't manage is huge income tax. And here's the other thing. So if the assumption right now is all of our federal taxes are going up, and so if you're going to get a bigger federal tax bill, whether you're a company or a high net worth or mid net worth individual, how do you mitigate that? You move to a low income tax state. And so you go to Texas, you go to Florida, you go to Tennessee, you go to other Southeast states that are maybe only 3 or 4% income tax versus 14% in New York or New Jersey. And you can mitigate the increase in federal taxes, whether it's capital gains or the billionaire tax or whatever it's going to be. And so you're going to pay it somewhere, and property taxes is where it's made up when you have low or no income tax. So, but you can appeal it, and I'm really good at it. I haven't lost a case in 26 years. So I'm doing a lot of it for major retailers and places like Colorado where it's very difficult, and we're winning cases on the facts and on the law, particularly for retailers. So I think there's going to be a lot of property tax appeal on office, hotel, retail. I think it's going to be harder on multifamily because you do have increasing rents. You do have declining cap rates and transaction activity to prove it. So buckle up. You're probably getting higher property taxes on multifamily and single family, and less so on office, hotel, and retail, which are going to be mass tax appeals the next 2 years.
Yeah. So if the interest rate goes up, right, so will there be a concern about the cap rates also going up?
There is. So if you think about it, one way you can build a cap rate up is your mortgage equity, mortgage dividend calculation, where you look at, what percent is debt and your mortgage constant, and what percent's equity and your equity yield. And, one's, 70-30 and it goes to 60-40 and one goes up a lot. You can see the resulting impact from a leverage standpoint, mortgage equity. I always do that when I'm doing an evaluation to test myself on my cap rate selection, because ultimately we need to use capital to finance. And that capital is going to dictate kind of what my cap rate is going to ultimately be, or the range. So I should be in the range of it. But you're right, as interest rates go up, that's eating away at your cash flow, especially your after NOI cash flow in before debt service. So it does have a suppressing and dampening effect.
Well, unless the Unless the inflation, increases the rent as well, right? Then you probably be neutralizing effect, I guess, right? So
yeah, get your cash flows out and get your cash flow skills skilled up and do your sensitivity analysis between rent increases, and that's why I worry that when the interest rates are likely to really start moving later this year and next year is going to be when all these programs come out and your ability to increase rents is going to be hurt. So it couldn't be a worse timing when your ability to raise rents is going to be the hardest at the end of this year and next year when all of these rent forbearance issues have to be dealt with, and that's likely when interest rates go up.
Okay, is there a most important thing that new administration could do to prevent any massive economic crisis?
Everything they're doing right now. I'm sorry. Secure the borders. Look at Texas, Arizona, whatnot. We have 100,000 a day. When you tell the rest of the world, whether you like Trump or not, but at least he secured the borders. We brought the crossings down. I think the numbers I heard today was we're seeing 100,000 more either a day or a week that are coming across the border than we did a year ago. Because when the message was, don't come here, or we were working with our counterparts in Mexico, in Latin American and South American countries to do their enforcement to suppress that, we were pushing back, we were tamping it down. And now when you have a new administration that says, everybody come here, free healthcare, free education, you also get a vaccination, what do you think is going to happen? And so you're talking 11, they don't even know if it's 11 million. It could be 20 million that come into the United States. They're going to get benefits. They're going to get medical. They're going to get education. They're going to get vaccinations. Good luck, California, Texas, and Arizona on paying for that. You guys are going to pay a huge, huge price. And so that, and then look at the tax policy, look at energy, increasing anything you do to increase energy costs is a tax. And so there's ways to deal with energy. Instead of a stick, you can use a carrot. So what's been the carrot approach? Shift more, have incentives that shift you more to LNG gas instead of other, gasoline or oil burning. Have a carrot that says, for every 5 miles you increase your CAFE standard on cars, you get a benefit. Encourage more of the credits on EV vehicles or whatnot. There's a way to do more carrot than stick stuff, but we are headed towards putting us back 5-10 years on energy. I'll tell you, I've already seen, I was buying gas for less than $2 a gallon before the holidays. I just filled up and it was $2.89 a gallon, almost $1 more in 3 months. And I think we'll see national averages above $3 going to $3.50 or $4 a gallon within a year. And that's another tax that comes in. So I think in terms of what the current administration can do is I think it needs to go back and do some economic analysis. There's things we can do where we can balance the issues and concerns about climate change in our environment without destroying whole industries, without destroying the costs of important commodities and whatnot. And I think, we should learn what is the lesson of Brexit in Europe. And the number one lesson is control your borders. And so whether we like Trump or not, I think he did achieve successes on controlling the borders. And where we're going right now is a complete wide open border, sanctuary cities. Look what's happening with police and law enforcement. I just think we go to these extremes. From extreme right to extreme left, where most of us operate somewhere in the middle. And we have so lost the ability to operate in the middle that I worry a lot about the future of capitalism in America. I think we could be writing the epitaph on capitalism. This could be like the beginning of the fall of the Roman Empire. It doesn't happen tomorrow or over 12 months, but where we're headed, this is not good for capitalism and our economy.
Got it. Last question. Can cap rates become too low where it's not realistic predictor of value indicator? Has it ever occurred?
It has, and it is right now in industrial. We're seeing cap rates in the 3% in some markets right now. That just doesn't make sense. And it's all being justified on, I need a yield. I want to buy a triple net lease. I'm looking for yield. I don't care about the underlying value of the asset. I'm buying the lease. I'm buying the cash flow. And then what happens is we wake up 3-5 years later and find out that the trade is at 6, 7, or 8% because debt costs have gone up so much. So yes, they can go too low. And that's why I say you really need to do that mortgage band of investment. Look at how the the cost of debt changes and impacts that cap rate. So if it's so much lower and it doesn't make justified sense between your allocation of capital between debt and equity, that should be a warning sign. The other thing is many of these assets are being treated as all homogeneous. Every multifamily is just like all others. They're all worth a 4 or 5 cap rate. Every warehouse is just like every other warehouse, and it's a 3% cap rate. And we've learned lessons in retail and office before. That's not the case. And you need to understand the fundamentals of a market and the fundamentals of that property. What's its age? Has it been renovated? What's the tenant, the credit of that tenant? All of those fundamentals. And so I think the market is throwing the fundamentals out. It's kind of like GameStop frenzy. Was it GameStop went back to $250 a share today? And it was $50 last week. I think some of the same stuff is happening with commercial real estate. People decide they like it one day. They like the hunt for yield. They think, well, gosh, who cares about a 6 cap rate? I'll be willing to do 5. That works in my margin with my debt right now. And tomorrow the other guy says, well, 4 works for me, and then 3 works for me, and nobody's looking at the underlying fundamentals. So it happens about every 10 or 20 years. We're going there.
All right. I think that's it. So for those who ask for the recording, I mean, you will get the recording, and you will also get the slide, right, Casey, if you guys want.
Absolutely. You can share those.
Okay.
And you tell me when you want to stop recording, and I'll do that.
Yep. I think that's it. Thank you very much. We can stop
Thank you,
recording
guys.
right now.
Hope you all stay safe and healthy, and hopefully we get together. I'm looking forward to maybe the CCIMs getting together in person in Pittsburgh later this year. And I know a lot of groups like NAI and others are getting there and stuff. And so stay healthy at the end here, get your vaccination, and do your homework. The fundamentals,
Absolutely.
the fundamentals still matter.
Absolutely. Thank you, Casey.
Thank you. Have a good one.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources, by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.